U.S. stock hitting new record highs yet again. HSBC expecting a powerful rally in the of risk assets in the coming months, but there are several risks to the upside and downside that could change that outlook. Joining us now, let's bring on Max Kettner, HSBC Chief Multi-Asset Strategist. Max, good to have you here with us this morning. As you're thinking about some of the potential risks here that are both to the upside and downside for the market, what are most prominent that investors should be apt to keep in mind?
I think, on the downside, given that we are so bullish going into 2025, it's probably more pertinent to talk about the downside risk first. Clearly, the biggest downside risk that we're seeing is still on the rate side. It is that effectively, we don't think we'll be wrong in our view. It sounds stupid to say, but effectively, it's almost like we're going to be too correct in our view, that really we're going to see too strong upside surprises on the earnings front, on the top-down front. And that, of course, would bring yields up. It would perhaps call into question the Fed's cutting cycle. Can they cut further? Do they maybe even have to hike again? Does the terminal rate have to be much, much higher? And that, of course, would bring long-end yields higher. It would bring bond volatility higher. And that really would be, sending a couple of ripple effects across all the risk assets. That, to us, is by far the biggest risk because it is so incredibly complicated to hedge, because of course both bonds would suffer, but also credit, also equities, also emerging market assets, virtually all asset classes combined, with the only safe haven being the dollar. Now, on the upside and on the positive side, look, I think some of the things around deregulation, yes, of course, but I think on the upside, there is still this really powerful combination the next 2-3 quarters of pretty low growth expectations. In fact, earnings expectations for the S&P the next 2 quarters are just for around about a 1% growth quarter on quarter, both for Q4 and for Q1 2025. And on top of that, low top-down growth expectations, still getting those rate cuts through. The Fed already starting to hint at perhaps starting to talk about the end of quantitative tightening. All of that is a fantastic setup. It's as Goldilocks as we can imagine, really.
And you point out, Max, that inflation risk is the biggest one, which is interesting in the context of the market's bullishness right now, sort of in part being based on the fact that the inflation war has been won. What will you be looking at heading into 2025 to really get a pulse on the state of inflation and the impact that will have on markets?
Yeah, I would look at things like super core inflation. Now, super core is, of course, the Fed's preferred measure of underlying inflation. It's sort of the most narrow definition of underlying inflation. That, however, is more likely going to decline in the first half of next year, particularly the first 4 months, mostly because we had these incredibly high readings in the first 4 months this year. So therefore, it's more likely base effects, things like vehicle insurance, that the resetting of that is not going to be as dramatically high as it's been in 2024 and also last year. That would bring super core inflation down. That actually is, again, another bullish factor for the next couple of months. I would say towards H2, when we're looking at a couple of other base effects that actually then would be driving inflation a little bit higher. And I would particularly point out inflation expectations at the front end. So short-term inflation expectation. I think about 2-3 months ago, I would have been much, much more worried about inflation because those short-dated, those short-term inflation expectations were significantly below 2%. They were already at 1.6, 1.7%. But what we've seen in the last 3 months is they've clearly gone up. They've gone up significantly to almost 3%. So at the moment, I actually do see inflation risks more on the downside for the next couple of months. H2, right, the second half might be bringing a bit more on the surprise side, perhaps on the hawkish side, but that is nothing which we should be particularly worried about right now, I think.
So, Max, what does that mean for your outlook for the first half of next year for the S&P? How much more room do we have to run, if you can put a number on that for us?
Yeah, I think like the next 6-7 months, I think you can easily have 5-10% up. I think it's really, really supportive for equities. I think for global equities, we're really seeing sort of about 12 to 13% more upside. in the next 12 months, so until the end of 2025. I think a lot of that could be front-loaded in the first half of next year, but I don't think it's just going to be the S&P. Within the S&P, I think there is really a basis for some of those sectors like industrials, a bit of like a mini re-acceleration there, but still liking tech here. I don't think it's just going to stop at the S&P though. I think that Goldilocks backdrop with better growth, better earnings, re-accelerating growth, certainly against growth expectations and consensus expectations, that could be benefiting also other asset classes. Still things like high yield credit, perhaps even things like emerging market assets in the first half.
You mentioned that you like tech, but it seems like as well that there's going to be a longevity test that's faced with regard to the AI trade. With that in mind, is there another sector that you think could outperform tech despite all the weighting that has been thrust towards technology thus far?
Yeah, I think, to be honest, in the next couple of months, I don't think it is, oh, am I buying tech or am I buying all the other stuff? So I don't think it's like, do I buy Magnificent 7 or do I buy the equal weighted S&P? I think it's more about tech and some of the other stuff, which could be things like, the industrials. When we look at the S&P, I think particularly US banks look great here. It's the financials, but in particularly the banks with perhaps hopes around some deregulation, but also with rates coming down, with volatility coming down, with already, some signs of a new capital markets cycle starting. That should be really favoring US banks over European banks. So it's not just, okay, I want to get out of tech and buy the other stuff, buy industrials, buy banks, perhaps even buy some of the healthcare stuff. But to me, it's more about tech and complementing with some of the other sectors.
Max Kettner, thanks so much. Always appreciate you.